All right, let's get right into it. Today, we're doing a deep dive on the variant perception for a stock that, for what felt like forever, was the safest house on the block, UnitedHealth Group. The market is just now, finally, starting to see the structural cracks forming in that foundation.
You know, for more than a decade, UNH was the absolute definition of a low-beta staple. It was that buy it and forget it core holding for institutions all over the world. It was the safety play.
And you can totally see why. A 15-year earnings per share compound annual growth rate of 13 to 14%? I mean, that's just staggering. It felt less like a company's performance and more like a law of physics. So the big question is, what on earth broke the model?
Well, that entire safety narrative has completely collapsed. It really kicked off when the company lowered guidance for the first time ever in a Q1 report. And what was the cause? Shocking weakness in its crown jewel, the part that was supposed to be the growth engine, Optum.
Okay, so let's really get into the weeds here. To understand the root of the problem, we have to do a full-blown forensic analysis of how Optum Health actually manufactured all that growth. Right, the whole thing hinges on a concept called risk adjustment. To put it simply, it's the system Medicare uses to pay providers more for taking care of sicker patients. So the sicker your patient base appears to be on paper, the more money you're going to make. So our deep dive uncovered some pretty eye-popping data. We zeroed in on Los Angeles, a really key market, right after Optum went and bought a huge physician group there back in 2019. So look at this. This slide really shows you the dramatic shift. Before Optum bought this group, their patient risk score was dead flat for 5 years, a perfect 1.0 baseline. But in the 5 years after Optum took the wheel, that score didn't just nudge up, it absolutely skyrocketed to 151. And let's be perfectly clear about what that jump from 1.0 to 1.51 actually means. We're talking about a 50% increase in the coded sickness of the exact same patient population. That is a massive, and you could argue artificial, jump in revenue that drops straight to the bottom line.
This was all done through what analysts in the space call aggressive risk coding. But the game's over. The government has caught on, and a whole bunch of new rules are making it way, way harder to code like this. This has created what we're calling a coding cliff, where all that engineered revenue is just set to fall away.
Okay, so let's move on. Let's see how this one coding issue dominoes into an even bigger, more structural problem. And that is the actual assets Optum owns and the incredibly opaque way they report on them. This brings us to what we've started calling the toxic provider assets thesis. The whole argument here is that UNH is now sitting on this enormous portfolio, 100,000 doctors and clinics, whose entire business model, their profitability, was built on that aggressive coding model, a model that is now basically impaired. I mean, think about the story they sold to Wall Street. Optum Health's long-term target for its operating margin was supposed to be a super healthy 8 to 10%. That was the core of the whole investment thesis. And instead, last quarter it printed a negative 0.8% margin. This is just a brutal textbook example of negative operating deleverage, as that high-margin coded revenue just vanishes. The high fixed costs of owning all those clinics, well, they swing the entire business into a loss.
So, here's the crucial point. The whole tech-forward innovator narrative might just be masking a much simpler and frankly uglier reality. Maybe Optum is just a roll-up of old-school legacy clinics that are drowning in tech debt, and their profitability was just propped up by a coding gimmick.
This slide right here, this just perfectly illustrates the transparency problem. As all these fundamental issues started to mount, the company dramatically, and I mean dramatically, reduced the number of subsidiaries it reported in public filings from over 2,700 down to just 10. It makes any kind of real forensic analysis next to impossible. Now the bull case, the argument from the other side, is that UNH can just reprice its core insurance business to cover all these losses at Optum. But if you look at the government rate outlook for 2027, you'll see a devastating 1-2 punch heading their way. First up, the government just announced a flat 0% rate update for Medicare Advantage in 2027. The market was pricing in a 5% increase. That's a huge miss. And second, they are devaluing the very same chronic condition codes, like COPD, that these aggressive coders relied on so heavily, cutting their value by almost 20%. So all of this brings us to the final blunt assessment of the entire vertical integration strategy, the very strategy that made UnitedHealth a Wall Street darling in the first place. So let's just put it all together. The bear case is actually pretty simple. The buy and hold, safe as houses thesis, it's gone.
The growth engine, Optum, is sputtering and has turned into a liability. The assets on its books are underperforming massively, and you've got these powerful regulatory headwinds already baked into the future.
And really, what you should take away from all this is the ultimate question for any investor looking at this name. Is the entire model of combining insurance, providers, and tech just fundamentally broken? Or is UnitedHealth just paying a temporary, albeit massive, complexity tax for its aggressive strategy? That right there is the multi-$100 billion question.